Good morning. Today I was taking a look at housing prices, and I wanted to share a few things that I found with you about, answering the questions whether you should be shifting assets into housing now, or what would be a good time frame for that, and when you should buy a house if you're going to live in it, and what are the factors in that decision as far as just the market timing is concerned. So I want to show a graph that maybe you're aware from the media, because the media is very, this is the news that's happening, this is what we see, this is the perception of the situation, and maybe you remember 2008's housing bubble, and then how it crashed, right? Well, up here, they weren't saying this was a bubble. They were saying, housing's going to the moon forever, and so it's very hard to get advice from those that were really wrong last time in their perception. And if you look at just the symptoms alone, you say, oh, that's the same thing as happening today. Right? Here's a housing bubble. Okay? Now, you come down to here, and let's look at, first of all, historically. This is all time. Here's your median income compared to your housing prices. Okay? It starts diverging back here in 1946. Okay? Right at the end of the war. Now, why does it start diverging? Well, people started buying a lot more things with mortgages at that point, with like a 30-year mortgage. And so the price of houses started diverging, based on other factors rather than just the median income. You have the median income, you have your inflation rate, you have the value of the dollar, you have, supply and demand was always there. And so it started diverging here. So this divergence is not a new thing where the median income is here and housing prices rise in relationship to it, okay? It's not new. 2008, here's the bubble. Here's where we are now. It's going to the moon, right? So let's just get a little narrower perspective on this. So let's go to 30 years. And let's notice this 2008 bubble and how it went down, okay? So how did it start? It started back here in 2000. Interest rates going down, 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 down. People were shifting out of the stock market because they had a big stock market crash. And they thought like real estate was, the safest, best return investment you get in. Even at the peak up here, most of the advice was, about buying real estate. Okay, people are buying real estate. They see it's the, the best return investment with the least risk, and well, it turns out to not to be. Okay, drove demand up. So let's look at where we are today. Well, today, if you take a view of the value in real estate, your comparison for 15 years, 2008. So you look at 2008 right here. Up here is the median income. Down here is the house prices. And you look at they're dipping below that line. So we're way down here as far as house prices compared to the median income. Okay? Why are we down there? Well, the biggest factor is that people were scared to death. I bought a house in 2011, bought a house in 2012, and some other houses in here, and people just wanted money out of that asset. They wanted to shift their what they perceived as their capital out of money, out of real estate, and into some other asset, right? And real estate wasn't liquid, so it was whoever's got cash or can close the deal, got a phenomenal deal as they moved out of those assets. And so over 2011, 12, 13, you've got that kind of a fear. Now, what happens later, if you look in here, is the prices start rising. Okay? Now, as your prices rise, it gets perceived as a safer investment. So people start doing what? Well, they start shifting more assets into that investment because it's perceived as a lower risk compared to the reward at that point. Well, in actuality, when it was perceived as a high risk was when it was the best value. Now you get into today. Okay? Now, you were definitely not deflated in prices. But you'll see some changes in here. Right here, you'll see median family income went down. Now, you could say, oh no, that's a horrible thing. But if you look at the historical perspective, like let's say 50 years, that median family income does that periodically along here. I don't know if you can see it on this, but here it does it in a few other places, okay? So this is not abnormal. What it means is, on average, people are getting paid less. Maybe there's a jobless rate. Maybe there's a slight slowdown in the economy, which is okay. But at this point, if you see the divergence line, what happened? Well, they did stimulus. Okay, so if you look at the graph right here, this last increase right here started in March of 2020. What did they do in March of 2020? They did a stimulus. Okay, is it hard to see the effect of the stimulus? No, it's right there. Everybody sees it. Okay, you want to say the stimulus didn't cause it? I'd say you're blind, right? The graph shows it right there. But the question is not whether the stimulus caused it, because we know that it did. But the question is housing something people should be moving into right now? So if you have assets, should you be shifting them to housing? Well, the answer is no. Okay? Because right now you're on kind of a high. Now, the other question is, will it resolve itself like it did in 2008? Well, what caused 2008? Well, 2008's stimulus here, or right here, in the crash, was caused by people selling. People were very excited about the stock. They took out margin loans. They were buying, and it drove the prices up. And then over here, they were selling out. What caused this one? A stimulus. So the two things that could cause that stimulus to make this go up, one would be that the money supply, the money going into the economy, caused it to go up. Okay? So then the thought process would be, if you stop putting money into the economy, then the prices will go back down. Okay? So you remove what you did before, and the prices go down. Okay? Now, the second cause, which is I think probably is the cause, is that the money supply was inflated. Okay? Now, inflation does not mean CPI, your bread prices, things like that went down. Okay? The truest definitions of inflation is in crypto. It's when you have a certain amount of something and you print more. Okay? That's inflation. Now, it's 30% more money that got printed. Well, is that money going to get unprinted? I don't think so. I mean, they're not going to start collecting that money. And so the stimulus itself, if it was what caused this and that money became available, it won't become unavailable. So those assets will probably still have a similar value because that money was inflated. Okay, now it's worth less than it was before. So you see your median income went down here, boom, and then here you get hit with inflation. Okay, so mean salaries are far below what they were before. They're getting paid in new dollars. New dollars are worth 30% less than prior dollars. But the question, becomes, for me is things like this, okay? If you have assets, should you be moving those assets into real estate? Well, the answer to that is probably not. Now, that doesn't mean you can't get a deal on a particular house or, buy something to add value or get something that really needs to sell and find a good deal. I have one of those on the hook right now. Second thing it says is, what should you be moving into? What assets should you be moving into today? So, what's perceived as risky? You look at housing down here, it was perceived as risky. Was it? Well, what's risk defined as? Look at the value. This upward trend was as people perceived this not as risky. And so, what assets are perceived as risky today? You've got Cryptocurrencies are perceived as risky. In the stock market, it's perceived as having very little risk, so it's probably pretty high right now. And so you're looking at, shifting assets not from the best risk reward ratio according to the media, but towards actual, risk reward, misalignment. Okay, so I'll give you an example. Okay, 2008, right here, this asset was perceived as solid. I mean, they were loaning you, tons of money to buy that asset because housing was seen as something that cannot go down in value. So the risk was perceived as very, 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 very low. Okay, with the increases in value just prior being very high. So people look at the little piece behind it and they say, "Whoa, this is the place I need to be." Okay, because it's ramped up in value, and look at this risk; it's so low. I mean, you can't lose money on it. So people move into that asset, and so when you get that type of feeling, it's probably not a great place to be. There are exceptions to that, but over here, you got the feeling nobody wanted it. Nobody wanted housing. And so when we get the feeling nobody wants something, that might be an opportunity if there's an underlying value in that asset, underlying value to buy it, right? And, we've talked about before cryptocurrency and how that applies, and what's seen as a value today. But, down here is a great time to buy, and, every once in a while there's something you can buy, but I wouldn't be shifting, assets into real estate today. Now, I bought several right here in 2019 that I got a value on, and as you see, those are doing really well right now, but I don't really perceive them having this full value. I think maybe they're more on like a linear graph here. Will the market drop the values? I don't think so, but I just don't see the underlying support, growing as fast as just the stimulus money. I think it's more that I bought a house with $100,000 money, and now that $100,000 money is only worth $70,000. So in perception, in reality, the house value stayed the same, but the value of the dollars measured in $1 went down by that amount of money. And hopefully that gives you a little guidance about, whether you should shift assets at least into real estate. Do I think you should buy your own house? Well, I think you buy your own house based on cash flow. How much is your monthly payment? How much money can you borrow? How long are you going to be there? And what's that interest rate payment work out? So if you're going to be at a location for 10 years, let's say, you borrow money at 2.5% to buy a house which is, let's say, 10% over value, then that's going to catch up in 2 or 3 years. Even if the house drops in value, quote, you're not trying to price it to sell it every week or every month or even every year. So you don't care. You care about the value it provides to you. So, I mean, it's okay to buy a house to live in for 10 years, because your interest rates and the value of money you're gonna pay it back with is okay. So, but I wouldn't go out and buy, 5 at market value thinking I'm shifting, from maybe Bitcoin into there, or I'm shifting from the stock market into there. It's not a good place to shift to at this point. Well, I hope that gave you some value. I do have crypto videos, and I provided some links down below that you can use just to access and open accounts. I get a referral fee on that, and you get something also. So I'll talk to you later. Have a great day.